Hi, everybody. Thank you so much for joining us today. We just have a few more folks filtering in. We will have a few more people joining us. We have a large audience that we're expecting today. So thank you for your patience as we let folks continue to trickle in. You're joining us today for what investors see in your cap table and other lessons with my friend Henry Kutarna, who is a seasoned investor. We're going to hear more about his background leading into this session, but he's really here to give our audience today some insights about what is in your cap table and what that means when someone is looking at your data room and your deal. So before we dig into that, I do just want to take a moment to acknowledge the ancestral territory on which I am located is Treaty 7 territory in southern Alberta. Inviting you to take a moment to reflect on the land where you are based, and also to send up a thought for all of those who are facing evacuations and emergency situations based on climate-related weather events that we are facing all across Canada right now, which is having very deep impacts across Indigenous and Inuit communities in the north right now, across BC and in other regions across Canada. Indigenous folks, First Nations, Inuit, and Métis people are the original stewards of this land and know how to take care of this land. And there are certainly opportunities for us to learn from their practices around forest management and sustainability as we move forward in a good way towards net zero for Canada. So I just would invite you to take a moment to think about where you are, and if you're in a safe environment today, to be grateful for that as we move into this session related to advancing climate-related goals with your businesses. So thank you so much for being here today. I'm going to hand it right over to Henry after just telling you a little bit about Foresight Canada. We are Canada's largest net zero focused accelerator, working with Cleantech ventures from coast to coast. We partner with innovators, industry, investors, academia, and government and other rights holders and stakeholders to relentlessly drive clean tech innovation in Canada. And our speaker today is Henry, as I mentioned. And Henry, I'm going to pass it over to you right from here. So we're going to dive right in with Henry's 18 plus lessons in cap tables. So Henry, over to you.
Great. Thank you very much, Leslie. Hello, everyone. Thanks very much for inviting me to present on this. Next slide, please. I'm going to tell you right off the bat that the perspective I'm bringing you today is that I'm an angel investor. So I have an extended family angel group that we've been active for about 25 years now. I also invest with my immediate family in real estate, and I have my siblings and I have invested in real estate for over 35 years. And I ran a tech group, an Invest Tech angel group in Calgary for 12 years. I've got an economic development background. I did some government work, Deputy Minister of Economic Development, Deputy Minister of Social Services. And I review about 150 deals a year these days. And I do a lot of mentoring work for startups. And, you know, I love the entrepreneurial spirit. And the reason that I'm telling you all of that is to say that today, the topic of the cap table, very important signals it tells the investor. Next, please. I think that oh yes, I wanted to say at the beginning too that I admire all of the entrepreneurs that are on this call. You know, it takes a lot of guts and sacrifice and hard work, and I really love the entrepreneurial spirit. So I'm really happy that you believe in your deals, and I just love that. So wanted to say that at the beginning. Next, please. So the perspective is, as an investor, I have looked at a lot of deals for my own situation, done a lot of due diligence. And in my coaching and mentoring work to companies, I've really seen a lot of things that the cap table tells you. So I'm going to begin by telling you 3 major lessons that I've learned. And in a few minutes, I've got 18 actual signals that a cap table will tell you. And we're going to zoom through those because I think it's important that we hear your questions too. I know you'll have lots of comments and questions. But first lesson at the highest level is the cap table does not lie. And so if you've accurately reported everything that goes into your cap table, the investor looking at your deal, doing due diligence, can really tell a lot about this. And so you can form a picture, and no matter how you construct your cap table, I say it doesn't lie. I can tell a lot of things from the cap table, and a savvy investor can do that quite quickly, actually, too. Second thing is that the cap table is a useful tool for an investor. So if you're an entrepreneur, putting a deal together, make sure that your cap table is fully accurate and lays out everything in fine detail, because it can provide the due diligence group with a list of questions. So even before I see somebody's pitch, and before I even dig into their data room, if I look at the cap table, it tells me a lot of different things. And we'll have some fun today. I hope you'll take a look at some of these 18 that I'm going to comment about. And then finally, number 3, the wise founder or entrepreneur, constructs the capital strategy for your company in such a way that it shows your wisdom and your smarts. And so I'm not saying you sort of study for the exam, you know what I mean? But it's like, create some value for your business strategy for the good of the potential investor that's going to come into your deal by constructing a strategy that's well thought out and well planned. I'm sure you know that, but these 3 are the top level lessons that I've learned over the years. And now we're going to jump right into the 18. So let's go next, please. Actually, before the 18, here's, I can tell, a good investor can tell from your cap table whether you understand valuation and growth and exits. We can tell whether you're a team player and coachable. We can tell whether you're growing, despite what you might say in your pitch deck. We can tell whether you're going to succeed in this sense, traction, or dilution. We can tell whether you have a loyal following just by the list of who's in your cap table. We can sense whether you can scale. We can see a pattern in your cap table of whether you're actually going to be able to exit, or whether you've diluted yourself out too soon, or whether you will never exit. And we're going to be able to tell you whether your forecasting is accurate, whether your team is likely to stick with you, and that has to do with the employee stock option plan and some other things. And then we'll also be able to tell when you will be diluted out. So I wanted to summarize these 10 just to say that it may sound, fairly assertive on my part to say that I can tell all of this, but with 100% accuracy. I'm sure you know that. But this gives me signals. And so as an investor, my family and I, or my friends who are investors, my colleagues, they all would say the same thing to you, that your cap table can tell, at least it can signal something such that it prompts us to ask the question. That's what the value of your cap table is. Okay, next, please. Here we are. So we're going to go through 18 of these, and I'm happy to take any questions that you have at any time. Before we jump into these, is there any question that anybody has right off the bat? I've been moving at high speed, but might there be a question, Leslie, from anybody?
None in the chat yet, but please do feel free to add your questions in the chat. We will pause periodically as we go through the 18 that Henry has laid out here. So if you have questions, feel free to put them in the chat, and we'll get to them in batches as we go through the presentation this morning.
All right, great. Okay, so the first signal that your cap table tells us is it tells us something about traction. So people sometimes make a claim in their pitch about traction, and the pitch deck is full of information about the traction. But we can tell from your cap table whether your valuation has actually increased and how much time has elapsed since the last round, right? That detail is listed there, and that gives us an immediate signal of whether you're in fact gaining traction on a regular basis or whether you're not. And one of the reasons that this is an important signal is because usually an angel investor looks for we want to make 5 to 10 times our money back in 3 to 5 years. Why do I say that? Well, because if we invest in 10 deals, 7 honestly will probably fail, and a couple will muddle along, and maybe one will be a home run. So we look for traction signals right off the bat. Next. So valuation, such an important thing. You, the entrepreneur, want to get the highest valuation for your deal. And we, the investor, want to get a great valuation as well. So here are some ways that the valuation signals are given to us from your cap table. Number one is the elapsed time between investments. If you have several rounds and there's a long period of time, or if there's a down round, which is the most dangerous thing you can have on your cap table. If you can avoid a down round, you will be, it's the best move you could possibly make. Incomplete rounds, rounds that are never finished, or delayed rounds, rounds that start and have an announcement that, we're going to close this round in December of 2023. And then it's March of 2024, and we're still talking about that round, and we see it on the cap table as an incomplete round. Or if we see share classes created along the way, new share classes, it signals something to us about valuation. Maybe good, like some major investor has come in and has negotiated something favorable for them, or maybe there's been some trouble and you've had to give concessions. So you see the signal is either positive or negative. And certainly the number of rounds. To have too many rounds is not good, because the lift from each round may not be there. And so anyway, valuation is a topic that I know you're very concerned about, and you should be, because we all want to make 5x, 10x, 20x on our investment. Next, please. Another signal that the cap table tells us is what I call the delta between rounds, the dollar value per share, let's say. So a big delta might signal great progress. Your first round was at $1 a share, let's say, and then the second round is at 250 or 5. If that's true, and it's combined with all the other signals, remember these 18 are not just individual signals. They have to be taken in combination, and some of them are more subtle than others, and there's nuance here. But a large delta might signal a really great progress, and therefore we would love your deal a bit more, and we'll dig into that during due diligence. But if it's combined with other signals, it can even foretell an upcoming down round, because too big a delta, right? If you start at $1 and instead of going to $1.50 or $2 on the next round, you go immediately to $5. If the valuation is not supported by your sales growth, by your actual traction, then we will want to dig into that, because it could actually foretell the bad news of an upcoming down round. And so an aggressive delta, aggressive dollar figure changes on a per share basis, would cause an investor to dig into your scaling strategy, whether maybe you've introduced new products, maybe you have new geographic markets, or you've done some price changes. So the delta is an important signal. And so when you're constructing your round, it would be important to think about what kind of a signal the delta in between the dollar figures tells the investor, as well as actually means for the valuation and the ultimate exit that you might want to have in your business. Next, please. By the way, if there are any questions, I don't know, Leslie, if you see anything yet, I'm happy to stop and take a question. Otherwise, we'll keep zooming through.
Nothing yet, but it occurred to me that we might want to pause and just confirm that the audience is comfortable with what a cap table is. We didn't actually define that at the beginning. So if you have a question on what a cap table is and we need to pause and go there, please put a note in the chat. Otherwise, Henry, feel free to keep on going. Okay,
Sure.
so I have a question. What is a cap table and what is a down round?
Sure. Okay, great. Thank you. So a cap table it's a short form expression for capitalization table. It's something that your investors will ask of you when you're creating a pitch for your company. And so if you want to raise capital, you want to raise angel financing or venture capital, you're going to have to show something called a cap table, which is a listing of all of the people who have owned shares in your business, what price they paid, how many shares they own, whether the shares have warrants or options attached to them. And so it gives you all of this detailed information in such a way that I can take a look at how many shares are outstanding. If you have 10 or 20 or 30 million shares that you're issuing, who owns what percentage of the business? When did they take those shares in? When did they come into the deal? And under what conditions, what type of shares they got? Was it What class of shares? Was it equity that they bought equity in the business, or did you get debt financing, like a loan from a bank or a loan from somebody? So that's what a cap table shows you. The down round idea is that it's the price of the round. So let's say when you start a business, you have friends and family money in, the founder puts money in, perhaps. The next time you go to the market to find capital, you might price your shares at $1 a share, let's say. And a down round would be that you take in a bunch of money, maybe you raise $50, $100, $200,000 in that first round at $1 a share. But then things slow down and there might be problems. You might not be achieving sales as quickly as your first thought. And so the next round of capital, you need to raise maybe $1 million, but your valuation of the business isn't there. And so your investors might say, well, I'm going to offer you 50 cents a share. And so the down round idea is that you did your first round at $1, but then you may have to drop your price to attract the capital because there's a supply and demand thing here. And if it goes down to 50 cents, you've just had a down round. So I hope that helps to understand what's happening here. Okay.
Question for you.
Yes.
Should an open round be reflected on the cap table or only included upon completion of the round?
I think that it's wise to include your all the open round information in the cap table because the investor will find that out anyway. They'll ask for it in due diligence and they will still need to take it into account. So it's best to, I think, show it even though it's incomplete. Okay, well, see, the overly aggressive up rounds with few takers. So here's it's very subtle. If you have an overly aggressive up round, meaning your first round, let's say use our little example, if it's $1, but then you say the second round is going to be at $4 a share. Well, that would indicate that your valuation of your business has gone up very significantly, 4 times or more. And that's pretty aggressive because you must be a high growth company if that's happening. And so if you do an aggressive up round like that and you price it high, you might have only a few takers. You might have only a few people that believe that valuation number. And then, they will they will have just a few people that'll be interested in it. And then subsequently, you might have a long close. You might have a long time, weeks and weeks and months will go by before anybody else comes along. If that shows up on your cap table, the investor sees that and they think, oh, this is, it's overly aggressive. Now, if it's a high growth company, it could be interesting. But if there are a few takers and a long period of time and your round is, extended by many months, then it's a sign of unrealistic expectations. And it causes us to then, when we do due diligence, dig into your company. Now, if you have up rounds that are reasonable and a short close, in other words, several weeks or several months, whatever it was that you specified, and that happens on a regular basis, we see that in the cap table, then it's exciting news. It's great news. Next, please. Here's another way to look at the signal, the percentage comparison between the dollar shares distributed to the founders and the dollar value of shares distributed to the friends and family. F and F is friends and family in the first round. If, let's say, you put $100,000 into your startup and the founder puts in, $95,000, and then some friends and family put in $5,000, we, the investor, will look at that and we'll say, okay, what's the proportion here? If the people who are close to you, who love you and care for you, are only willing to put in $5,000 and you're putting in $95,000, we're not saying it's good or bad, but it might signal to us that it's a lukewarm response. Like, why wouldn't your friends and family, if they believe in you, put in more than $5,000? And certainly they may not be capable, and we understand all of that, but it's a signal. It can signal also a lethargic kind of situation. If you are founding a business and even your closest friends and family and associates are not willing to support your initiative by putting in some more significant dollars, then it's a signal to us, and we look into it. And so it's not a profound point, but it's a point it's quite interesting for us to see how closely the friends and family support you in your deal. It's an important signal. Next, please. Okay, classes of shares. You'd be familiar, perhaps, with the fact that when you issue shares in a business, there are all kinds of them. If you do research online on this and just, type in the code word share classes or classes of shares, you're going to see a lot of variation. And so investors generally prefer, and I'm one of them, I prefer that everybody gets common shares. Everybody, friends and family, founders, first and second round of angel investors, I prefer that we all get common shares. Same principles apply, same rules, same benefits, no special deal. What I don't like to see is, the founder gets preferred shares, which might be voting shares, and then other people might get non-voting shares, or the preferred shares have stronger voting power per share than the common shares. So the investor who's trying to put money into an early stage company really appreciates this "we're all in it together" thing. Because if you signal by the use of a single class of shares that everybody's in this together, we're all pulling together, we're all harmoniously, working together, that's a great signal to an investor. But if you have a mix of all these different kinds of shares with different powers and authorities and responsibilities, and some people are voting or not voting, it can signal other things. I've listed a few of them here. There could be greed. There could be private deals, favorable treatment of certain individuals. Sometimes close family and close friends are given voting shares and others are not. And that could signal to us, some kind of a dynamic inside of the family or inside of the close associates group that says that this is not a harmonious, unified kind of group. So the number of classes of shares and the powers and authorities that are given to each of the shares, such as voting or non-voting, preferred or common, these signals are all important for us as an investor. Next, please.
Before we move to the next one, Henry, we've got one question. Is there a family and friends percentage or ratio that indicates a strong level of support?
Well, it's a good question. I think my own experience would be that if I see that a friends and family round or founder round contains about 25% friends and family money and about 75% money from a founder, then I'm encouraged. Then I see, okay, there's some belief in this deal. No one expects you to match, the friends and family to match what the founder puts in. But if I see a 25% number, then I see, okay, there's some harmony here. People believe in this. But if, as mentioned a few minutes ago, if I only see, 3 or 4 or 5%, 95%, then that tells me, well, why aren't people putting in a little bit more money into this thing? And I understand fully, by the way, I'll say it again, the means that some people have. Maybe friends and family can't afford to buy the shares. I understand that. But at the same time, we will still be curious about why that's the case. And that's why the cap table tells so many interesting and actually beautiful signals.
So that might be one of the questions that you can expect to be asked, is about the ratio in your friends and family around, and to have an answer about that fits for your circumstances and that builds confidence with a potential investor.
Absolutely. Right. Yes.
Okay.
Here's another, it's another type of signal about voting and non-voting shares. If somebody issues voting shares to a particular group within a round, so let's say you've got, let's say there are 25 investors, I'm just making up a number, and they all put in around $10,000 each, but some of them get voting shares and some of them get non-voting shares. Once again, we, the investor, will be curious, why is that? Is there founder misalignment? Is there a reason that somebody who's founding a business wants to have the voting shares in a control block and some other people not have voting shares? And if it's a family business where a lot of startups occur, does that mean family conflict? And so I've seen it a million times, you could say. Um, some founders will issue themselves the voting shares so that they control the business, and then they'll issue to, spouses or children or extended family members non-voting shares. In a certain sense, nothing wrong with that. But again, the signal that it sends to us as investors is why is that? What's the reason? Is there conflict? Is there misalignment? Is there a future governance issue? When the company gets bigger and people put in more capital and the business grows, who's leading it? Who's on the board then? Who actually controls the company? And why is voting shares concentrated in a smaller group of people? Even at the exit time, there could be a conflict. When if you want to exit a deal in 5 years, let's say, you want a nice smooth exit. You want a company to come in and buy you out and take you out. But if they come in and they say, well, just a minute now, there's some voting shares and there's some non-voting shares, sometimes the people who have the non-voting shares might not like the deal, the exit deal. And so then they'll sue or they'll fight. And so you have possible future exit conflicts. Whereas if everybody had voting shares, or if the process was clearly laid out, then there'd be clarity on that. So that's this voting and non-voting shares. It's an important signal, and many people I call it a mistake of not having a good strategy or not having a good explanation for why some shares are voting and some are non-voting. Next, please. Okay. ESOP is an employee stock option program where you distribute or sell shares to employees in the company. Sometimes it's called shadow equity, where it's not really shares that are distributed, but they get benefits as if they had the shares. It's a very complex subject, and some people call this all golden handcuffs. This is interesting. It's a signal to us as investors. If you have, let's say, 10 or 15%, even 20% of the total number of shares in the business available for employees, key employees, that can be a good thing, because you're applying what we call golden handcuffs. You're having your key team, your CEO, your CFO, your marketing people, your technology people, buying into the deal, wanting to stay for a long time, because we, the investor, we don't want change. We don't want your team to have troubles, and we want this team to stay together. So you could send a very great signal to investors by having a good percentage of your business, the shares available to your employees. Now, if it's too high, it's a problem. The ideal number from an investment point of view, most investors would say, 10, 15, even 20% is good. But if you start to give more than that to key employees, that's a signal of a possible problem. If it's too low, if you have 0% given to employees, then we would wonder why. Why is it that no employee is going to get shares in this business? How are we going to keep them? If they're key employees, how are we going to retain them? What's the stickiness factor? Where are they going to go? And then if you have, these questions come about and at least warrants an investigation. Do you have an employee stock option program? Is there staff shadow equity? Is there a staff retention plan? Golden handcuffs. This is all very important signal to the investor, because one of the greatest contributions to valuation is the team. It's many years ago, there was a Kauffman Foundation study done. You may have heard about this. You could look it up. What's the greatest contribution to valuation? It's the team. It's not the technology. It's not the business plan. How many people, 3 years ago, a lot of people had business plans, but guess what happened? They were all thrown out the window when the pandemic came, right? And so the team is the number one contribution to valuation. And so we, the investor, we look at your cap table and we see, wow, here's an important set of key employees. They're going to be able to, and I'm not saying you give the shares away, you can give some and then they can earn some and they can buy some. There's a lot of different ways to do it. But if we see a good, healthy percentage of the company shares going to key employees, that's a positive signal. Next, please. Similarly, if you have shares that are allocated to your board, and remember, there are two kinds of boards. There's an advisory board, and then there's a governing board. And so sometimes an advisory board might be short-term, and you may not give them shares. You may just pay them a stipend, or maybe they're volunteers. But the governing board, if they also are major shareholders, they may automatically get a seat on your board. They may negotiate that with you. But if there's no shares allocated to the board, then we wonder if the founder has a coachability problem. Are they coachable? Because the beauty of a board is that it's independent advisors who watch your back as a founder. And so a good, strong board can help keep you on track. It can help keep the company focused in the right direction, and it can help strategize all the different stages of growth and commercialization. So we look for a percentage signal as to how many shares are allocated to the board and to the officers of the company. That would be the chair of the board, the vice chair, the corporate secretary, the head of a finance committee or a HR committee, something like that. If there's no shares allocated, we wonder if there's a coachability problem. We'll at least ask that question. And we'll wonder if there's a willingness to accept external advice. Because when investors put money in to a deal, as you well know, they may want to sit on your board. And at the very least, they'll want to offer advice. And so the moment, as they say, the moment you accept outside money, you're accepting business partners. And it could tell us that there's an unwillingness to move towards standard governance models inside of a company. So this is the number of shares given to board members or available for purchase by board members is an important signal to us as well. Next, please. Here's another really great signal, and it's the dream of every entrepreneur that I've ever seen, to find a lead investor, somebody like a super angel who puts in, let's say you're raising a $500,000 round, and you find this great angel investor who loves your deal, supports you, is going to be of great help to you, and they're going to put in 100 or 150,000. That's a great signal. If we see that in your cap table, most investors are quite encouraged by that, because it can signal that a complete round is going to happen here. Because when the lead investor comes in, if that person is a respected angel investor, then they're going to attract smaller players who may put in $5,000 and $10,000, but they may attract a whole series of them. And so it can signal a complete round, and it can signal a broad round. In other words, lots of $10,000 investors who then have confidence, and it can signal therefore a good following. So we look for whether you've been able to attract a super angel. It's not always the only signal that's important. If we didn't have a super angel, but there was broad acceptance of your deal by all kinds of different people, that's a kind of a signal too. But the super angel, the lead investor, as it's called, the sooner, and we look for this particularly, the sooner that lead investor comes on board and shows up on the cap table as an early investor, the more overjoyed we are, because that's a great signal. Next, please.
Thanks, Henry. To add, once you've got a lead investor, it is obviously easier to get your follow-on investors that are coming in to close out your round. So always a good place to focus. But we have a question. When should a startup begin drafting their cap table? We are early stage and pre-revenue, and our advisors are usually just volunteers.
Yes, that's. I understand that situation. I would say that you should start drafting your cap table right away, because even if there's only the lead investor being the founder and maybe some friends and family, you at least then get used to showing that on a cap table and understanding the consequences of it. So I'd start right away. And it's like, when you set up a company, they tell you to keep your minute book up to date. And a minute book is the chronicle, the registry of all the different resolutions you pass and all of the different circumstances. So I'd say cap table right from day one in its simplest format, even if it's only got that founder investor on there.
And we certainly can put together some resources if you're looking for a sample cap table, or you can Google it. There are lots of resources around how to physically build that document and some templates for that as well. We have another question for you, Henry.
Yes.
It's a little bit more ethical, theoretical. Can a governing board that owns shares in the company be truly independent in executing its fiduciary duties?
It's an excellent question. So the person who asked that question is on the right track. A governing board is, first of all, their interest must be the interest of the company. Yes. But at the same time, they are supposed to bring what we call fiduciary responsibility. And that means that they have to be guided by a set of principles and ethics. In other words, they have to do things that are legal and, you could say morally and ethically correct and right and sensitive to the customer and, the stakeholders and the employees and all of that. So the job of that board member it's very difficult. And sometimes what happens, maybe this is where the question is going, you see, particularly in the newspapers, you see in the media, these big sort of fights that go on where a board has turfed the CEO because of some, a famous phrase is moral turpitude. They'll sometimes fire a CEO for some failing, or a board will have conflict within itself, factions in boards. There are some Canadian examples of major Canadian family-owned businesses. You might know what I'm talking about. I won't necessarily name the families, but they're fighting within the board. So you've got siblings that are controlling blocks of shares and they're fighting. So anyway, if the question is going towards the ethical issue, the prudently guided board member must look out for the interests of the company and must do that all in the context of legality and sort of ethical and prudent decision making. That's hard. That's a subjective thing in many ways, isn't it? It's hard to be objective about that. But at the same time, in the art form, I'll say that there's a science and an art to being a board member. The art part of it is that you have to have a sense all the time as to whether the team is pulling together. And if they're not, if the CEO wants to take the company into a direction that's harmful to the business, that's where you get a good independent board coming to, into its fore, you could say, into its strength and trying to change things. And a board does give direction to the company. So the CEO may or may not be a member of the board, but it's the governing board that actually does govern the company and gives its direction. So anyway, I could go on, but I wonder if that solves that question.
Well, Henry's other passion just so happens to be governance and ethics. And so that's a topic for another conversation. So let's move on. Henry, just flagging, we've got 20 minutes left in our session.
Yeah, good. Thank you. Thank you. Okay, so here's another signal that the cap table tells us: the relative size of investment from top to bottom. Like your super investor puts in, let's say I'm making up a number, $1 million, and then the smallest investors are putting in $5,000. That's an item of interest. We just want to know, who's the biggest player and who's the average player and who's the smallest player, because that can tell sometimes. If we have a lot of small investors, it could signal poor traction. Nobody's too excited about the business. Like some people want to support it or they want to risk a small dollar figure, $5,000, that let's say you're letting that kind of a dollar figure come in. If you have a lot of those small investors, it could show poor sales or poor traction just because people aren't too excited about this or not willing to devote more resources to it. And a high variation between the top and the bottom. If you've got $1 million investor and then you've got a bunch of $5,000 investors, there could be a governance problem. And I'm not saying there will be. I'm not predicting it. I'm just saying we would look for that because we'd say, wait a minute, the $1 million investor is going to want to control the company. And they may, in fact, have the control because they have the votes, yes. But at the same time, a wise corporation, a wise startup takes into account all the advice that it gets, not only from the lead investor that has, that can vote 1 million shares versus some other people can only vote, 50,000 shares or something like that. It's still important to be sensitive to the input of all of these different groups of people. And all I'm saying here is that the signal is that if there's a high variance, it could possibly be a governance challenge. Not necessarily, but again, there's these 18 signals are not independent of each other. They're all subtly linked and they're nuanced. Okay, next one, please. Yeah, many small investors, there's another kind of signal it sends to us. Maybe that deal, if there's a whole bunch of small investors, maybe it's more of a social enterprise thing than a commercial business. And maybe it should actually become, I'm not saying a social enterprise or a not-for-profit, but maybe it's suitable for crowdfunding instead of, equity financing. Now, this is something that you want to do at the beginning. You want to think about this, but some deals are actually more suitable to crowdfunding than not. And so, we need to know that. And maybe if we look at a cap table in the first round and we see a whole bunch of small players and no real lead investor, we will ask, okay, maybe this thing should be taken to crowdfunding, because that's the way they're going to get a broad base of support from dozens and dozens and hundreds of people. And maybe it's a signal to move to a tax advantaged model. I don't want to get too technical with you, but sometimes we can invest our RSPs, or if you're in the United States, your IRAs, into a company. And so tax advantage means that we could invest that and we get the growth in our RSP tax-free, right, until we take it out. And so sometimes a lot of small investors showing up on a cap table can signal to us that it's possibly a social enterprise, or maybe it's something that should be done on a tax advantaged basis. Next, please. Here's a very sensitive problem. If you have a down round, so let's say the first people came in at $2, and then the next round had to be priced down to $1. Well, now you've got people that paid $2 a share who are stuck with their shares that they paid $2 for. And then all these other new people are coming in at $1. And so sometimes the founder of a business will try to help and make whole those first people. And that's called anti-dilution, because what's happened to the $2 people is their shares are now only worth $1. So they have half the wealth or half the investment that they put in. So companies often put together what they call an anti-dilution pool of shares. And so they might, to keep those $2 people happy and committed, they might issue them additional shares to make them to double their, you could say to double the number of shares at half the price equals their whole. They're the same as they were before. It's a crisis of confidence. It's in an angel investor exit. VCs often will force you to solve this. If you have a series of down rounds or a bunch of small investors, when the VC money comes in later on, like 2 or 3 or 4 rounds later, the big money comes in, they may squash the angels. They may force them to sell their shares at below what they paid for. Anyway, the whole concept of an anti-dilution pool is an important one. It's very technical, but when you study it, you could do some research on it. It's pretty intuitive. So we'll leave it at that for now, unless there's other questions. Okay. When you have valuation uptick, in other words, the rounds are priced higher and there's actual valuation increases, the business's value actually grows. There's a, whoops, where are we? Oh, here we are. It could signal an early dilution problem. In other words, if you are selling shares, if you're riding the wave of increasing rounds, you might dilute yourself out too soon. And so the whole point here is that you have to watch that you don't get diluted out too early. The rule of thumb usually is don't dilute yourself more than about 30% in any given round of investment. because if you do, you can get diluted out too soon. And you have to be balancing that whole point across the concept of a smaller piece of a bigger pie. So the founder is often torn between, diluting themselves out too soon, and if they stay longer and give up more equity, they can still get a smaller piece of a bigger pie and still increase their wealth. So there's a lot of signals about the uptick calculations, which we can get into in detail. Next, please.
We've got one question for you. What is the difference between anti-dilution and ratchet down protection?
Ratchet down protection and anti-dilution. I think it's the same concept. There might be subtleties, but it's the same idea that if there's a down round or the price of the shares goes down, sometimes companies try to protect those people who bought in early and supported the company in its earlier days. So I believe it's the same concept.
Or at least the same function. Thanks so much. Next slide.
Okay. Next item. What's a clean cap table? Well, distinct upticks in valuation. Shares every round priced higher, commensurate with the real valuation of the company. In other words, not artificially priced higher, but really well-spaced rounds. You raise money for, let's say, 18 months in round one, and then you realize you're going to need 3 years of capital. So you raise second round soon after the first round closes. Nice tight close, predicted to be 3 months, closes at 3 months. And then a gap of 2 or 3 months while they work at their company and they use their capital and so on. And then the company starts growing and then you do another round. Quick closes within a reasonable time period. This is a great test that investors always look at. How quickly do you close a round? Are the rounds extended for like a year or 18 months? Well, that's a bad signal. And so a clean cap table signals a well-run business with great traction and high probability of an exit at a great multiple. This is a good signal to us. So clean cap table is a thing, and it's something to be aspired to. Next, please.
Keeping in mind that a quick close within a reasonable time period is an important signal, what would be your advice to the founders on the call of when to open their round? What are some of the signals they need to be watching for of when they can kind of officially open?
Well, the idea would be to do your forecasting very well. So to have an excellent spreadsheet analysis that does all your scenario forecasting of product growth, new geographic markets, new product features that you add. So doing very great cash flow forecasting will tell you then almost automatically, I don't want to say, without work, but it almost automatically tells you when your next round is needed. If you're going to burn capital at a certain rate and you know that in 6 months from now you're going to be out of money, you need to start raising capital, 3 months before that, let's say. So I would say that the answer lies in, doing good financial cash flow forecasting. That's the way to find out when you should open and close rounds and when you should time.
Perfect. Next slide for you.
Okay, next one. Yes, thank you. Some other signals. If we see a cap table that has, 3 to 5 years and you're near exit at that point, it's a great signal. If we see a cap table that's 7 plus 10 years, whatever, that's a sign. It's like, wait, what's going on here? There's no exit in sight. What's happening? Is there traction? Is the company slowing down? Is there competitive pressure from some other competitors? Is there a leadership problem? Is there a sales problem? So the obvious signal is time. If it's a nice 3 to 5 year tight little company that has an exit that's imminent, well, investors love that. And so, but the long deals are a sign of usually trouble. It's very rare that somebody who's struggling 7, 8, 9, 10 years suddenly will have an exit. That's fantastic. It rarely happens. Next, please. We're at the last two here. Investment instruments. We also look for in your cap table the balance between equity, that is people who buy shares in your business, and debt, that is money that you borrow from the bank or from people or from a line of credit or whatever. Because sometimes there's an imbalance that gets created. So if you have debt, which, for example, has greater power and strength, you might then make business decisions that favor the debt holders as opposed to the equity holders. And a high percentage of debt could signal future conflicts. In other words, if you're beholden to the bank will usually be in first place on in a creditor situation. And so if you run into financial trouble, or if you can't pay your debts to the bank, then the poor equity holders, the people who bought the shares, are going to be in trouble, right? But if there's a low percentage of debt and there's a high percentage of equity ownership in the business, well, the owners of the business have more power and authority. So one, in what you call a capital strategy, you need to balance between whether you're going to just take people's money to, sell equity in your business and they're going to buy shares versus borrowing. And so there's a whole sort of theory and a whole bunch of discussion goes on in the due diligence phase. When an investor is looking at your business, they're going to ask you, do you plan to debt finance? And under what circumstances will you debt finance? Because it might determine whether I put money into equity in your business. Complex subject. Next one, please.
Any questions around the equity and debt question before we move on to the next slide? I'm going to move on for the interest of time.
Okay. Excessive number of share classes. We spoke about share classes a little bit earlier. And if you have, five or six different, and I've seen this, I've seen deals where there's like 5 different classes of shares: voting, non-voting, preferred, common, this, that, the other thing. Why? What's the point of all of that? We need to figure it out. Sometimes that mess has to be cleaned up later on. And then some people are going to get hurt. There's going to be down rounds, or there's going to be anti-dilution needed. And it can also signal conflicts. Like, why does somebody have voting shares and somebody else doesn't? What's the reason? What's the underlying reason? And then if there's, there could be special deals or hidden arrangements. Sometimes, particularly in family members, they want to control voting. And I understand the reasons for this sometimes, but when you have too many classes of shares, that's a signal to us that there's something that we need to dig into. So next, please. There you go. I really appreciate the chance to tell you all these things that I've learned over the years. Interested in your questions and happy to answer anything that's on your mind.
All right, we've got a few minutes left here. So if you have any other questions that you want to throw in the chat for Henry, or feel free, I believe you have the ability to raise your hand if I'm not mistaken. But please feel free to put forward your thoughts and feedback. As we wait for a couple more questions to pop in, I'll just turn it over quickly to my colleague, Amanda.
Thank you. Thank you so much, Henry, for that informative session. It was really, really cool. I just wanted to speak a little bit about our acceleration ramp. So if you are interested in accelerating your venture by leveraging experiences of amazing and fantastic executive residents like Henry, we are currently recruiting for our fall programs until August 27th, and then also rolling intakes throughout the year. We offer an acceleration ramp consisting of different programs catering to companies at different stages with different needs, starting from ideation all the way to scale. So wherever your company is, we have a program that can support you. I will post the application link in the chat. And if you have any questions, feel free to reach out to me, and we look forward to helping you accelerate your venture. And back over to you, Leslie.
Great. Thanks so much, Amanda. We had one question about the slide deck. We will send out a recording of this session and the slide deck to folks on the call, so you can reference back to these lessons and the discussion. We do have one more question. If the round takes months to close, what options does the entrepreneur have?
That's a great question, and it happens quite a bit. And so what happens if the round is taking too long to close, then you're faced with some stark reality. Is the product mix right? Do you have the product roadmap right? What's the problem with the sales? Is the sales cycle too long? Can you go and get some interim financing? Can you go back to the original investors and say, we need another round of working capital? Can you please contribute more? So, the thing is, it signals a challenge, but the good news is that there's a lot of creative solutions to it. It's a very common problem, but there's a lot of creative solutions, like going back to the investors in the first place, or examining internally what's going on in your company with your sales force and your product and all of that sort of thing. And at some point, companies do find themselves on the path to, failure. We hate to use that word, but it happens. And if that's the case, the better your financial analysis along the way, every week, every month, the sooner you'll be able to see this problem and then take action. So it's a great challenge. Having great advisors, having smart money, having capital that comes in that's very smart, can advise you, is usually another way to get out of that problem.
Yeah, letting your investors help you, letting them understand what's going on in your business so that they can help you bring in other folks who can write you checks to help get through that hump. They have a vested interest in your business. So if you have an opportunity to bring them alongside you in solving problems, they want to help because they have a vested interest and they believe in you.
Exactly. Well said. It's true. And that's why selecting, in a certain sense, it's not that you're interviewing investors, but in a sense you are. You want to select well, and you want people that actually do care about the business and are willing to help you with advice.
Well, thank you so much again, Henry. Thank you all so much to everyone who came and spent an hour with us today. I think there was a range of experience and expertise on this call, which reflects the composition of the Foresight Venture Network. So if you're super early stage and some of this felt over your head, come work through our acceleration process. We do have an access to capital program that includes readiness to raise support. We'll help you with your cap table. We'll help you with your pitch. We'll help you with your pitch deck. So we really encourage you, to consider applying to the Accelerate from Anywhere ramp in order to access all of those amazing benefits. I do also want to quickly let you all know about our Foresight 50 showcase. This is our announcement of the 50 most investable clean tech ventures in Canada. That list is currently being chosen by our 40 investor judges. But if you want to come, if you're not in the list or you didn't apply this year, you can come join us on November 8th for the celebration, meet all of the folks who are in the room, be a part of the momentum around our list. And if you are an investor or other strategic partner, please feel free to reach out to me about opportunities on the 9th for our private investor forum connecting investors to the Foresight 50. So we've got some ticket sale links there. Use code EARLYBIRD to get 25% off your ticket sales for the celebration on the evening of the 8th. That will bring your ticket price down to about $35 for some drinks, hors d'oeuvres here in Calgary to connect with the clean tech ecosystem, and we hope to see you there. One more time, I want to say a huge thank you to Henry for sharing his experience and wealth of knowledge on this topic. Henry is one of, as Amanda mentioned, many EIRs and mentors in our network. He is one of the folks that sits on those fundraising committees and helps folks with their readiness to raise. So come and benefit from the amazing talent we have and the brain trust that we can pull from to support your business. So we hope to see you in the fall. Thank you so much for coming. Feel free to reach out to me or Henry or Amanda if you have any other questions. My information is on the screen there, and have a great rest of your day.